Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be talking KiwiSaver. As always with these types of videos, this is just my opinion. This isn't financial advice or anything like that. But we've obviously got a lot of New Zealand viewers on this channel, and I've been asked a few times about how I personally go about setting up my KiwiSaver to kind of grow it over the long term and all of that kind of stuff. So I'm going to run through this. It's a pretty basic strategy, so it's not going to be too long of a video, I don't think. So let's get into it. If you have any questions, drop them down below. But if you've got any genuine, tricky KiwiSaver questions or anything like that, seek financial advice. Don't just listen to a guy on YouTube. But here's my opinion, and this is how I sort of set it up anyway. So let's get into it. Alright, so as I mentioned in the intro there, my approach to KiwiSaver is pretty simple. So I guess there's really two sides of KiwiSaver. There's how much money are you actually putting away to go into your investment funds, and the second thing is what are you actually doing with that money once it's in your KiwiSaver fund. So let's tackle the first part of that first. How much do I actually put into my KiwiSaver? How much do I kind of deposit every fortnight when I get paid? And the answer to that for me is basically the minimum that my company will match. So that's what I think everybody should be doing at the very least. So the lowest rate that you can put into KiwiSaver is 3%, and that's what I choose to do, and that's what my employer matches. So if your employer matches 3%, which they have to by law, then you should be taking that every day of the week. If they match up to 6% or 8% or some higher rate, I think you should take that any day of the week as well. So that's what I do personally. They match up to 3%, so I take that 3% and that's what I put away. And anything over and above that 3%, they don't match. So obviously, you know, I'm making some videos on investing on YouTube here, so I'm clearly pretty into investing. So I like to take any of that extra money and have a bit more control over it and do things personally in my own sort of brokerage accounts and kind of keep that separate to KiwiSaver. But I think for the majority of people that really aren't into investing, I think there's probably a pretty good argument for, even if your employer's not matching money over and above 3%, contributions that you put in over and above 3%, I think there's a pretty good argument for just going ahead and maxing it out anyway, especially if you know you're the kind of person that is probably just going to spend any extra money you get on new shoes or going to the movies or going out for dinner or anything like that. So if you're in that camp, it's probably not a bad idea to just max the thing out and invest as much as humanly possible. If you're more like myself and your employer matches kind of the minimum percentage and you want to do your own investing on the side, I don't see any reason why you can't tackle it the way I have, by just putting in the minimum, taking the employer match. Essentially it's an instant kind of 100% return if your employer is matching a certain amount of money that you put in, and then take the rest of that money, save as much as you can, and put that into investments in your own time as well. Okay, so that's part one, pretty straightforward in terms of how much money I save and how I kind of funnel that money into KiwiSaver. The second part of it is where is it actually invested, and this one is actually quite a different approach to what I take in my personal kind of on the side investing, and there's a couple of reasons for that. So essentially I've just switched over quite recently to Simplicity. This isn't a Simplicity sponsored video or anything like that if you're wondering that, but basically I've got all my money in KiwiSaver wise in the Simplicity Growth Fund. Essentially that is about as low fee as you can get in New Zealand, and it's about as aggressively as you can invest with Simplicity with KiwiSaver money. So it's putting about 80% or there or thereabouts 80% of the money into shares. That's a mix of New Zealand, Australia, and other countries kind of share markets, and then it's putting the balance balance of about 20% to a couple of different things. So the vast majority of that is going into fixed interest investments, so things like bonds and term deposits and that kind of stuff. lower returning assets, but something where the return is guaranteed. So if we do have a stock market drop or anything like that, I'm still going to be getting some sort of return from that portion. And then there's just a small fraction that's sort of sitting in cash, so about 1 or 2% last time I checked. So that's sort of the asset mix in that growth fund. And there's a couple of reasons that I've chosen to go with that one. So I'm 24 years old. I'm not going to be hooking into my KiwiSaver money for some time is the plan. So essentially I want to invest with something that is going to give me the best long-term growth. And there's a couple of ways we can kind of set that up. So the first thing is to have it invested relatively aggressively. In practice, what that means is having a high proportion of it in the stock market and shares. So that's what I've chosen to do. And the second thing is having as lower fees as humanly possible. So with Simplicity, they charge a $30 per year kind of base fee. And then they charge $3.10 for every $1,000 that you have invested in your KiwiSaver. So with that setup, by the time that you get over about the $10,000 mark, which you should be doing over a long period of time, I would hope, you're getting kind of down to that 0.5% per year, or even potentially a lot lower if your KiwiSaver fund is much larger. So you're getting into relatively low kind of management fees, and this is really the main reason why I actually switched over to Simplicity. So previous to that, I was just in one of the kind of default KiwiSaver funds that you just sort of get put into when you first set up KiwiSaver, and it's an actively managed fund. So this is a real sort of pet peeve of mine, is the whole actively managed fund world. If you've ever dug into mutual funds and that sort of thing, you'll know that most of the money in the stock market is actually managed by mutual funds. And as a result of that, on average, the performance of mutual funds is the average of the stock market. Over the long term, there's very, very, very few mutual funds who will outperform the stock market, even if they're actively managed over a long period of time. And even if they do outperform it, if they outperform it by 0.5% or 1% or 2% even per year, which is unlikely, most of these funds are charging at least 2% in management fees per year. So even the very best ones are instantly sort of cancelling out that alpha, those extra gains, through the fees that they're charging. So for most people, I think you're going to be better off just going low fee, as low a fee as possible. And this is what's really grown the sort of exchange traded fund, index fund kind of world, as people have started to switch on to the investment industry not really adding anything to them. And it's a pet peeve of mine, because I see, when I watch TV, there's all these ads popping up from various KiwiSaver providers, and they'll say things like, my KiwiSaver is actively managed as yours, and they'll say, what's actively managed mean? And they'll say, it means that my money's working as hard as possible for me. And things like that. And that may be the case. There may be people, buying and selling and doing research and all this kind of stuff, but they're not actually really generating you any benefit out of that. And even if they are, the amount that you're having to pay them through salaries and bonuses and all that kind of stuff to actually manage your money is cancelling out all of those extra gains, and some for most cases. So that's the way I set up my KiwiSaver. I've got a long-term time horizon, so I'm invested fairly aggressively, as low a fee as possible. I'll put up some screenshots here of what a 1.5% or 2% fee difference can make in the long-term growth of a KiwiSaver fund, and I think it's something that's really important to understand. So that's my KiwiSaver setup. Hope you enjoyed the video. It's pretty basic. One of the other reasons that I sort of set it up that way is it's almost like a bit of a hedge to my own investing. I'm really picking individual companies and trying to pick investments that are going to do quite well and run with a relatively concentrated portfolio. So if I completely mess that up over the next couple of decades, I should have some KiwiSaver stuff on the side that's been tracking the market and kind of ticking along as well. So it's a little bit of a hedge in that way as well. I'm hoping that's not going to be the case, that I do really poorly. I like to think I'm going to do okay. But just in case, it's almost there as a bit of an insurance policy as well. So that's me. That's my KiwiSaver setup. If you've got any tips or tricks or anything anything around KiwiSaver as well, definitely drop them in the comments below. I'm no expert by any means in this department, so drop them down below. I'd be interested to hear your thoughts there. But that's all from me today. As I say, if you enjoyed the video, hit like, hit subscribe, and I'll see you in the next one. Cheers.
The KiwiSaver scheme being actively managed, what does that actually mean?
It means your money's not lying on your couch eating all your biscuits.
Join the hardworking ANZ KiwiSaver scheme today.
What? Bro, what are you talking about, man?